probably seen the recent news reports with regards to mortgage interest rates. In fact, they have just fallen for the third consecutive week to record lows. They're lower than they've been in 50 years. So today we're just going to take a brief minute and look at what that means to you if you're thinking of buying a home and how it impacts home affordability. Hi, this is Andrew with the Andrew Smith team at eXp Realty with my faithful assistant Bailey over my shoulder there. And mortgage interest rates, they're crazy low right now. But what exactly does that mean? What does it mean to you? And in order to explain that, we're going to look at the three main factors that go into home affordability, or the three main factors that make up home affordability. The first is mortgage rates. The second is mortgage payments as a percentage of income. And the third is home prices. So when we look at the first factor of mortgage rates, it's insane to me how low they are. You know, it wasn't that long ago when I didn't think mortgage rates could get any lower than they are right now. And here we are hovering right around 3% and even just under 3% for a 30-year fixed rate loan. But what exactly does that mean? Okay, so let's just put this into a little bit of perspective. So let's assume a $300,000 loan amount, and we'll look at this by decade. So that payment today would be $1,270 a month based on today's interest rates. In the 1970s, the average mortgage interest rate was around 8.86%. That mortgage payment on that exact same loan amount would have been $2,384. You look at the 1980s, the average mortgage rate in the 1980s was 12.7%. That would equate to a $3,248 a month mortgage payment on the same $300,000 loan that you're going to pay $1,270 for right now. So as you can see, I mean, it's a massive difference with nothing changing except the interest rate. So there's no wonder why those record low interest rates have helped spur buyer activity and demand into the marketplace. So then as we go back and we look at mortgage payments as a percentage of income, what we're looking at there is housing affordability, right? So that is measured most commonly with a housing affordability index. And what it's looking at is it's saying, okay, how much of our monthly income do we need to spend on our mortgage amount? And what it does is it measures whether or not a typical family earns enough money to qualify for a mortgage loan based upon typical national and regional levels. Okay, so here is what the actual graph that they use to track this means. They have a baseline value of 100. So to explain what a 100 measurement means is a family that makes the median income in a given area or nationally has exactly enough income available to qualify for a mortgage on a median priced home in that community. Okay, so it's looking at median priced home, median income, and if the family has enough income, median income, to qualify for the median home, that community or that area would be right at the baseline of 100 points. And this does assume a 20% down payment in that case. 20% down payment is absolutely not needed, and I've linked here to another video that I did recently that explains that. If you get on this index anything over 100, it means it's more affordable. Homes are more affordable than they have been. Well, you know, in the blog post I'm going to do accompanying this video, which I'm going to link to in the description below, we're looking at the home affordability index going all the way back to 1990. And in fact, since 1990, homes have only been more affordable than they are right now 3 separate times, 3 separate years. And all 3 of those years were between 2009 and 2014, when the market was dominated by distressed properties. Right now, the reading is at 172. So we're at 172 points on that scale. The highest the reading has ever been is 197, which was back in 2012. Okay, and then you flip and you go the other way. In 2006 and 1990, for instance, that index was at 108. So even though it was at 108, you can see it was still above that baseline medium that they were looking at, but nowhere near the 172 that we've got right now. So what does all of this mean to you? Well, it means it's a great time to buy. Ultimately, as I've always said, you should only buy when it's the right time in your life for you to buy. But if you've been sitting on the fence trying to figure out, should I, shouldn't I, you've got to take a look at these interest rates and factor that in. Yes, there could be some concern that prices are going to go down. I went into that in detail in the monthly market report for July I did last month, which I'm also going to link to directly below. And, the other thing to keep in mind is that with interest rates, this is something that people don't necessarily always follow or understand. A 1% increase in interest rates decreases your purchasing power by 10%. Okay? A 1% increase in interest rates decreases your purchasing power by 10%. So let's put that into an example for you. So let's say right now you qualify for a $400,000 purchase, using a round number, at 3%. If the interest rates start going back up in the next year and those reach 4%, all other things being equal, your income being equal and everything else being equal, you now only qualify for a $340,000 purchase. Okay, 10%, I'm sorry, $360,000 purchase. My math is a little bit off this morning. 10% of that 400,000, 40,000. Okay, subtract that from the 400, you're at 360. So interest rates simply going from 3% to 4% could decrease your purchasing power from 400,000 to 360,000. So it's something that you always have to weigh yourself back and forth. That's why as interest rates go up, you also start to see a lot of potential home buyers jump off the fence to lock in that low rate for the long term. Because chances are, with everything that we're seeing right now, even if over the next 12 to 24 months, real estate prices tread water, or potentially go down 1 or 2% in some markets, they're going to be going up in others. The average length of time someone stays in a house these days is about 9 years. So if you're anything like the average homeowner and you're in a home for 9 years, you've locked in a ridiculously low interest rate now. That home is going to gain value over the next 8 to 9 years. And the amount of equity that you're going to build will be substantial, especially since less of your money is going to mortgage interest. All right, so I hope that makes some sense. If you've got any questions about how this works, or want to know if now is the right time for you to consider buying a home, please feel free to reach out. I'm always happy to talk to you. Contact information is also directly below in the description of this video.